You make $120,000 a year. Good credit. Money saved. You did the part they told you to do. And you're still sitting there staring at a mortgage calculator like something has to be wrong. You punch in a $400,000 house and your stomach drops. The payment isn't tight. It isn't a stretch. It flat out does not work. So you lower the price. $375,000. Then $350,000. Still broken. Sound familiar? You're not bad with money. You're not behind. You're not failing some basic adult test. You're using a 2019 key on a 2026 housing market. Here's what actually happened. Homeownership didn't disappear. It got turned into a luxury subscription service. Same dream, same sales pitch. Now the basic plan doesn't get you in the door. And nobody announced the price hike. It wasn't one thing. It was 5 locks added quietly. Price, rates, insurance, taxes, HOA. Each one annoying on its own. But stacked together, they move the gate far past where a normal 6-figure household thought it would be. This video breaks down exactly how those locks were built, what the math looks like for a $120,000 household in 5 different cities right now in 2026, and why the most dangerous part of owning a home in America today has nothing to do with your mortgage rate. And that last part is where this really turns, because the thing that wrecks a lot of buyers now is not the number they obsess over on day one. It's the one that sneaks up after closing. The formula used to be simple. Work, save, buy, build equity. Repeat it enough times, and it starts to feel less like financial advice and more like physics, like gravity, like something that just works. And for a long time, it did work, but only because a very specific set of conditions held it together. Home prices had to stay connected to incomes. Rates had to stay low enough that a median earner could actually service a median mortgage. And starter homes that first rung on the ladder had to actually exist in enough supply that normal people could reach them. Those conditions started cracking in 2020. And by 2021, they were gone. Here's what happened. Mortgage rates hit record lows. 2.65% on a 30-year fixed in January 2021. Money had never been cheaper to borrow, so demand exploded, and prices followed. The median home sale price went from roughly $329,000 in early 2020 to over $400,000 by 2022. That's a 20% plus jump in under 2 years, but wages didn't move like that. Not even close. Now let that math land. In 2021, you needed to earn about 17% more to buy a home than to rent one. That gap was manageable. Uncomfortable, maybe, but manageable. By 2025, that number had climbed to 82%, and it's still rising. The income you need to buy the median U.S. home right now is $117,000 a year. The median household income in America is $86,000. That's a $31,000 gap sitting right at the bottom of the ladder. Think about that for a second. The very first rung. Not a dream home, not a great neighborhood, just a median home requires an income that 60% of American households don't have. And that's before insurance, before taxes, before HOA, before a single repair. The ladder didn't disappear. The bottom rung did. And what replaced it wasn't opportunity. It was a paywall. But here's the weird part. There is still one major market where the old math hasn't fully died yet. One place where a $120,000 household can still look like a real buyer. We'll get to that city in the audit. So how did we get here? How does a country that built its entire middle class on home ownership end up locking that same middle class out? It wasn't one dramatic event, no single crash, no single villain. It was 5 separate locks added quietly over 4 years, each one compounding the last. And the trap only becomes visible when you stack them all at once. Lock 1 is price. The median home in America right now sits at $424,000, up 4.5% from last year. Incomes did not keep pace. Lock 2 is the rate. In January 2021, the average 30-year fixed mortgage rate was 2.65%. Today, it's about 6.5%. On a $400,000 home with 10% down, that adds roughly $900 a month to your payment. Same house, same block, way more money. And the people who locked in at 2.7% aren't moving. So inventory stays tight and prices stay high. Lock 3 is insurance. This is the dangerous one. The national average for homeowners insurance hits $3,057 in 2026. But the real story is regional. Florida averages $8,292 a year. California is up 16% in 2026 alone, and 49% of homeowners now say insurance costs shape their buying decision more than the home price itself. We'll come back to that because this is the lock that breaks the rest. Lock 4 is property taxes. Assessments lag price spikes, so even if price growth cools, your tax bill can keep rising because the county is still catching up to 2021 and 2022 values. Lock 5 is HOA. 40% of homes for sale now carry HOA fees. The national median is $135 a month. In Florida, it averages $617. That's before repairs, before special assessments, before anything goes wrong. None of these locks kills the deal by itself. The stack does. And that stack creates something worse after closing, a kind of payment creep that can turn a fixed mortgage into a moving target. I'll show you how right after we run the city audit. And your $120,000 income is about to look strong in one market, shaky in one, dead on arrival in two. Let's make this real. Forget the national averages for a minute. Lock in a single household. $120,000 a year in income. That's $10,000 a month gross. 740 FICO score. 10% down. A master-planned single-family home with an HOA around $200 a month. $2,500 deductible to keep premiums as low as possible. And a hard 36% DTI ceiling, meaning total monthly debt, everything combined, cannot exceed $3,600. That's the math. Now run it through 5 cities and watch what happens. Pittsburgh first, because Pittsburgh is one of the few places left where a $120,000 household still looks like a real buyer. The income needed to buy the median home there is $66,350. The premium over renting is 14.4%. The median home is about $228,000. With 10% down, you're financing roughly $205,000. At 6.5% principal and interest is around $1,300 a month. Add taxes, insurance, and a modest HOA, and you're still well below that $3,600 ceiling. That means margin. Margin for repairs, margin for a car payment, margin where escrow moves. But here's the catch. Pittsburgh prices are rising 9% year over year. The math works today, maybe not in 18 months. Now, Dallas. Income needed to buy the median home, $122,000. Premium over renting, 110%. Your $120,000 household is right on the cliff edge. The median home in Dallas is $396,000. At 10% down and 6.5% principal and interest is around $2,250. Add taxes, insurance, HOA, and you're already crowding $3,200 to $3,400 a month. One insurance bump, one tax catch-up, one HOA hit, and you're over the line. Dallas doesn't say no. It says yes with no room for error. Miami is where the insurance lock becomes impossible to ignore. The income needed to buy the median home in Miami is $151,000. You're already $31,000 short. Florida averages $8,292 a year in homeowners insurance. That's $691 a month. Add the state's average $617 HOA, and $1,308 is gone before a dollar of principal gets paid. The numbers don't close. Then there's San Jose. Income needed to buy the median home, $408,557. Premium over renting, 218%. Median home price, $1.5 million. With 10% down, a $120,000 household would finance about $1.36 million. At 6.5% principal, and interest alone is roughly $8,600 a month. Stop there. Your entire 36% DTI ceiling is $3,600. San Jose blows through that before taxes, insurance, or HOA. The math is dead on arrival. And that's the point. Six figures used to mean options. In 2026, $120,000 buys you one functional market, one edge case, in two cities where the math simply does not close. Now, here's where it gets worse. You can survive a bad purchase for a few months. What kills you is when the payment keeps changing after closing. Here is the core reveal. Here's the betrayal nobody warns you about. When you lock in a mortgage rate, you think you bought certainty. You sign the papers, you know the number, and that number stays put for 30 years. But your housing cost is not your mortgage, and that is the trap. Back in 2020, the non-mortgage part of owning, insurance, taxes, HOA, was background noise. In 2026, in a lot of risky markets, that side of the bill is now 35 to 45% of the total payment. Your mortgage is fixed. Your housing cost is floating. That's the escrow inversion. The part you can't control is now eating the part you can. You thought you bought a fixed payment. What you really bought was a fixed loan inside a floating shell. Let me run some quick math. Take our $120,000 household. They bought in a mid-tier Sunbelt market in 2022, locked 5.5%, felt smart, payment worked. Then the escrow line started moving. 2023 insurance renewal, up 18%. 2024 renewal, up another 14%. They raised the deductible to $2,500 just to stay in the game. Then 2026 tax reassessment hits. Another $280 a month. Then 2026 shows up and the insurer sends the letter nobody wants. Non-renewal. Not a big increase, not a warning, gone. Now you're shopping for coverage on a deadline because your lender still requires insurance, and you are not shopping from a position of strength. You're shopping because the old carrier left. Private insurers are pulling back from wind, flood, and fire zones. The new quotes come in way higher. Some carriers want a new roof, updated wiring, cleared brush, flood vents, or a 4-point inspection before they even write the policy. And if you can't get private coverage fast enough, you get dumped into the state's FAIR plan. That sounds safe? It isn't. The FAIR plan is the insurer of last resort. It usually costs more and covers less. Higher premium, higher deductible, more exclusions, and in a lot of cases, it does not give you enough coverage by itself. So you need a second wraparound policy just to fill the holes. So now the payment didn't just rise, it got more fragile. And here is the brutal part. Every extra $100 a month in insurance cuts your buying power by roughly 15 to 20,000 under a 36% DTI cap. That is not a line item. That is a different house, a different zip code, a different school district. This is why people get confused. They think they messed up. They think they bought too much house. But a lot of the time, the loan didn't fail them. The shell around the loan did. And it never hits all at once. A renewal here, a reassessment there. An HOA dues hike because the association's master policy blew up. Each move looks survivable by itself. Stack them together, and your fixed mortgage starts acting like an adjustable one. Your mortgage is fixed, everything around it is not. That's the shadow mortgage, and for a growing number of homeowners, that is the bill deciding whether they get to keep the house. But here's where the math gets even more uncomfortable. If you take the same gap you're bleeding into escrow and invest it instead, in some markets, you can beat home equity by 6 figures over 10 years. Let me show you that math. So let's talk about return. Because this is where the story stops being emotional and starts being mechanical. At a 7 to 8% long-run market return, buying in a lot of these markets is a bad trade for the first 7 to 10 years. Not close. Not maybe. A bad trade. Start with the down payment. On a $424,000 median home, 10% down is $42,400. Put that in a basic index fund at 8% and leave it alone for 10 years. You're at roughly $91,000 to $96,000. No roof, no tax reassessment, no insurance non-renewal. Now look at the buy side. You hand over the same $42,400, then you pay closing costs, then PMI, then repairs, then the shadow mortgage stack. And in 2026, median home prices are not exploding higher. A lot of markets are crawling. The rent versus buy gap makes this even more brutal. Nationally, the income needed to afford the median home is about $116,633. To afford the typical rental, it's $64,160. That is an 82% gap. In 2021, it was 17%. Think about that for a second. The system wants you to compare rent to principal. Wrong comparison. You need to compare rent to total ownership cost. And total ownership cost on a median home is now roughly $1,400 a month higher than renting once you stack principal, interest, taxes, insurance, PMI, and HOA. That $1,400 is the whole game. Invest $1,400 a month at 8% for 10 years, and you're in the range of $250,000. Liquid, diversified, yours. Not trapped in drywall, escrow shortages, and special assessments. That is the wealth leak. Not because renting is magical, because overpaying for a weak asset with a huge carrying cost is financial self-sabotage. Pittsburgh still works. Cincinnati can still work. But Miami, Phoenix, Dallas, San Jose, in those markets, renting and investing, the gap is not a fallback. It is the higher ROI move. And the ugliest version of this is rent to own. It sells you the feeling of ownership without giving you real equity. Extra fees, messy clauses, one missed payment, and the option can vanish. You keep the risk. They keep the upside. Homeownership didn't become fake. It became tiered, and if you buy in the wrong tier, the wealth leak starts on day one. Homeownership wasn't banned. It was paywalled. Same dream, higher tier. So run your city's real numbers. Income required, total payment, insurance risk, HOA, DTI ceiling. Run all of it before you buy. Because in a lot of cities, renting and investing the gap is not plan B. It's the smart move. This isn't giving up. It's refusing to buy a bad deal because the culture still calls it success. If this changed how you think about the housing market, share it with someone still running the old math, and subscribe. Because the next video breaks down the geo-arbitrage play and how to build wealth as a renter in a paywalled market. Homeownership still exists, but for millions of Americans, it no longer works like an asset. It works like a trap wearing the costume of success.